Warren Buffett invested over $3 billion in HPQ stock in the first quarter of 2022. The stock is now down roughly 27% from the lowest it was trading for in Q1 as well, which means the stock is selling at a significant discount to where Warren Buffett's average cost is. This is leaving investors with the question of if HPQ stock is a buy now at a discount to where Buffett was buying it, or if Buffett was initially wrong about the business. In this video, we are going to go over HPQ stock and do our best to answer this question. HPQ is the company that makes HP laptops, tablets, and printers. Over the past 5 years, the stock has been slightly outperforming the S&P 500, but when we include the dividends into the total returns, then it has returned almost 100% over the past 5 years. 69% of the company's revenue comes from personal systems like laptops, desktops, and tablets, and 31% comes from the company's printing segments. The company also sells its products around the world and has 65% of the revenue come from outside the United States. However, the revenue in North and South America and over in Europe declined over the past year, with only the revenue coming from Asia still growing. So what we're going to do first is head over to Stock Unlock and take a look at HPQ's insights. This is the first thing that I always like to do whenever I take a look at a new business, is use our insights because we score, grade, and analyze the key fundamental data that investors like to pay attention to. So right away, we can see that HPQ has a dividend score of 4.3 out of 5, which is pretty good. The forward dividend yield right now is above the 5-year average dividend yield, so right now, investors buying HPQ stock are getting a higher yield on cost than the stock has offered over the past 5 years. The dividend per share is also increasing, and it increased by 25% over the past year. The 5-year dividend per share has increased at a compounded annual growth rate of about 13%, and the payout ratios are quite low. So this business has a dividend yield that's pretty high right now relative to its 5-year average. The dividend is growing and the payout ratios are low, so the dividend does look like it is quite safe. If we scroll down, we can see that this business has a profitability score of 3.0 out of 5, which is like as average as it gets here on Stock Unlock. The gross margin is below 20%, so that's kind of bad. The operating margin, the net margin, and the free cash flow margin, however, are all average at around 10%. The cash conversion is also about 73%, which is good. Now, if we move over to the company's growth score, it's about a 3.4 out of 5, which is also just kind of average. The revenue has increased by about 4% over the past year. Nothing amazing, okay? So HPQ is definitely not a growth stock. HPQ, if I had to put it in a little bit of a box, it would be full on a value investment. This is like a typical Warren Buffett value investment, as we're going to see. So yeah, the revenue is not growing. Gross profits are not growing. Operating income is not really growing. Net income did increase by 54% over the past year, but operating cash flow and free cash flow did decrease and book value did increase. Basically, your revenue is not growing, operating income is not growing, net income grew, but cash flow isn't really growing either. If we scroll down to the financial health, 2.7 out of 5, kind of average. The current ratio is below 1, and we grade that as bad because the company doesn't have as much current assets as it does current liabilities, so it's going to have to use some of its free cash flow to pay off its debts over the next year. The intangible assets as a percent of total assets is below 20%, so that's kind of average. But check this out, the shares have decreased by nearly 14% over the past year, okay? So this company buys back a lot, and I mean a lot of its shares. On top of the dividend that it pays, it buys back so many dang shares, it is ridiculous. The debt to EBITDA ratio is also below 2, which is kind of average. But the the book value and the tangible book value are both negative, which is kind of bad. So basically, when I take a look at the stock, I see a business where the financial health is just kind of average. There's nothing amazing there. It is buying back a lot of shares, though. The company's not really growing. Revenue's not really growing. Operating cash flow isn't really growing. Gross profit's not really growing, and operating income isn't really growing. So the business just really isn't growing. It's also not like incredibly profitable. It is profitable. It is generating profits, but it's not like, it's not like Adobe where the margins are insane. And then the dividends are growing quite quickly, and the dividends do look like they are quite safe because the payout ratios are very low. That's kind of the overall view that I'm getting from HPQ right away. So now let's head over to the company's financials here, and let's take a look at the revenue. Right here, we're going to zoom into about 2016, and we can see that over the past 6 years, this company's revenue has trended upwards. However, in the trailing 12 months in the last quarter, the revenue did slightly decline. And we did see that the revenue is growing by about 4% year over year in the trailing 12 months. Now, if we head over to the cash flow statement, we can see right here that since 2016, The cash from operating activities has kind of just been stagnant. It's not like growing, and it kind of looks like it's also cyclical, where the operating cash flow has periods where it's growing and it's up at like 6 billion, then it drops down to like 3 billion, and it kind of looks like it's cyclical, to be honest. Right now, we're also seeing that the cash flow is dropping, and in the trailing 12 months, the operating cash flow is now sitting at 5.4 billion. Let's scroll down to the free cash flow, and this is kind of the same story when we zoom into 2016. It looks like it's more cyclical, and the free cash flow in the trailing 12 months is now at $4.6 billion. Now, what's also interesting here is we can see that HPQ has paid out about $1 billion in dividends over the past 12 months. However, take a look at the net common stock issued. When this number is negative, it means that the company is buying back shares. And HPQ has repurchased $5.3 billion of shares in the trailing 12 months. Again, compare that to the dividend. It means that they're spending like 5 times as much money on buying back shares as they do paying the dividend. They spend a ridiculous, and I mean a ridiculous amount of money buying back shares. And let's actually head over to Stock Unlock's freeform tool right here. And I want to show you guys what this kind of looks like when we do a comparison on our chart right here. So we're going to go to dividends paid, which is the dollar amount of dividends that they're paying out. And then we're going to go to the net common stock issued, or net stock issuance. We can see that HPQ pays out about $1 billion in dividends, and then that net common stock issued is negative 5.3 billion. So what we can do is put these two numbers together, and we can go to the net amount returned to shareholders, which takes the dividends and the buybacks that the company is doing, puts them into one number, and just shows you, okay, how much money is this company actually returning back to shareholders just on a combined basis. And in the trailing 12 months, it's about $6.3 billion, okay? Why this is so significant is because, remember, this company just returned $6.3 billion to shareholders, and the market cap right now is $25 billion. So they've returned almost 25% back to shareholders through buybacks and through dividends in the trailing 12 months now on the market cap today. If we actually go to the percent return to shareholders, we can see that right now it is in fact at about 25.1%. And if we zoom out to about 2013, the last time the company was, repurchasing this many shares and delivering this much money back to shareholders was back in 2016. And that is, I'm serious, you guys, that is a ridiculous amount of money that HPQ is returning back to their shareholders. If we go to the company's shares outstanding, take a look at this as well. We're going to zoom all the way out here to about 2004. And back in 2004, this company had 3 billion shares outstanding, okay? Fast forward to today, and the company now has just over 1 billion shares outstanding. So they've repurchased about 66% of their shares over the past 18 years, and they've lowered their share count by 2/3. They've bought back 2 billion shares over the past 18 years. Now, we can also see that this is a compounded annual growth rate of -6%. So on an annual basis over the past 18 years, on average, they've repurchased 6% of their shares every single year. Now, if we fast forward to 2012, it increased to about 6.5%. And if we look at the past 5 years, they've been buying back about 10% of their shares annually over the past 5 years. So that's what I mean. This company is so dang focused on buying back shares, and it is just eating up its share count. That's basically where all of the free cash flow goes. However, take a look at this, because if we actually take a look at the free cash flow and the net amount that they return to shareholders right here, we can see that the free cash flow was 4.6 billion in the trailing 12 months, and the amount that they returned to shareholders in the trailing 12 months was 6.3 billion. What I'm noticing here is the amount of cash that they're returning to shareholders is more than the company is actually generating. Again, think about this. They spent $6.3 billion on dividends and share repurchasing, right? But they only had $4.6 billion in free cash flow. So where is that extra cash coming from? Well, if we take a look at the company's long-term debt, we can see that the long-term debt is spiking right now. In the first quarter of 2022, long-term debt was sitting at what, 6.4-ish billion dollars, and now it's sitting at about 10.3. So over the course of this year, really, over the past 3 quarters, this company has taken on about $4 billion more in long-term debt. And it looks like they're doing that to accelerate share repurchasing. So they're taking on debt to buy back shares. I don't love this, but I mean, when you take a look at this company's free cash flow yield right now, the free cash flow yield is sitting at about 18.3%. So they can buy back shares and get an 18.3% free cash flow yield on the shares that they're buying back because the stock is so cheap. And who knows, maybe it does actually make sense for this company to take on some debt to buy back shares because of just how low the stock is. I mean, if we go to this company's price to free cash flow, It's now selling for a price to free cash flow of only 5.5, which is like really, really low, to be honest. I do have a screenshot right here, however. I went over to their investor presentation and I want to find their outlook. So here their outlook says that they're expecting free cash flow of about 3.2 to 3.7 billion for this year. The middle there is about 3.4 billion. And when you do the math, it means that HPQ is now selling for a price to free cash flow of about 7. Now, if we go back to our freeform tool and we take a look at the the price to free cash flow out to 2016, this company has traded at an average price to free cash flow of about 8. So even with its future projections of 3.4 billion dollars in free cash flow this year, it does look like it is still selling below its 6-year average. Now, the last thing that I do want to point out is that analysts are not expecting HPQ to grow its revenue. They're actually expecting HPQ's revenue to decline by about 5% over the next about 4 years. So analysts aren't really expecting this company to grow. And we also saw that the company isn't really growing. I mean, revenue grew by 4% in the trailing 12 months, year over year in the trailing 12 months. And it doesn't really look like it is a growth company. So in my opinion, why Warren Buffett is buying this business is because he's not buying it because he thinks the company is going to grow. He's buying it simply because of how much cash this business is generating and its price today. Again, it's selling for about a 5 price to free cash flow, a 7 forward price to free cash flow. And in the last year, it's returned 25% to shareholders through buybacks and through dividends. I mean, this company pays a 4% dividend right now, and it bought back like $5 billion worth of shares in the trailing 12 months. And it's reduced its share count from 3 billion to 1 billion over the past 18 years. So it's just delivering so much dang money back to shareholders that I think at this point, Warren Buffett doesn't even care about growth. He's just like, continue buying back shares, continue paying the dividend and continue buying back shares, and Warren Buffett will be happy. I think that's what he is seeing with the stock. I think he just thinks that it's so dang cheap. And I think he thinks the free cash flow is going to continue coming in. So in my opinion, that is why Warren Buffett is buying this stock. And if that is his thesis, then I mean, fair play. This looks like a straight up value investment. I don't think that it's really going to grow that much, the fundamentals of the business, but if it can continue buying back like 10% of its stock every year, then the free cash flow per share is going to grow theoretically at 10%, even with no free cash flow growth, just because the share count is decreasing. And with the share count decreasing, the owners of this business, the shareholders, are going to increase their wealth in this business and their ownership in this business. That is why I think Warren Buffett is buying it. Let me know what you guys think down in the comment section below. And also, let me know if you like this video. If you did like this video, then please leave a thumbs up on it. It really helps out our channel. And if you're new here and you want to see more stock market related content like this, that's not hype and it's 100% fundamental value based, then please consider subscribing to the channel because that would also be awesome. One last thing, if you are interested in this platform right here that we use on the channel, this is Stock Unlock. We are building out this platform so much. We're currently building like the best portfolio tracker that's going to exist on the internet. And we're also building an insight screener, basically a stock screener on steroids. That's how you could imagine it. I've personally started playing around with our insight screener and I've already found a handful of stocks that look incredible, okay? It's going to be an amazing screener. It's going to be an amazing portfolio tracker, and Stock Unlock is just incredible, okay? If you're a long-term investor or someone looking to improve your own investing and improve your portfolio, then this platform is for you. You can go and get a 14-day free trial. You don't need a credit card or anything. You'll get full access to the platform. And I pretty much guarantee you that if you use this platform every day for 2 weeks, you're going to improve your investing. You're going to become a better investor, and your portfolio is probably going to improve as well. It's just a fantastic platform. You guys can go and try it totally risk-free and check it out and let me know what you think. Yeah, that's going to wrap up the video though, everyone. Thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in our next video.